A woman named Stephanie Kebede bought 22 rental units in 18 months. On paper, those units throw off about $158,000 a year. Then she sat down in front of a camera and said she regrets it. That video has over 1 million views. It is not a story about one bad tenant. It is someone who hit the number and wants out. Here is the line that stops you cold. She says that as they kept buying more properties, she just became more broke. Millions of people are told the same story. Buy property, rent it out, retire on the income. The Census Bureau's Rental Housing Finance Survey counts around 19 million rental properties in this country, and roughly 70% of them are owned by ordinary individuals rather than companies. So this is not a fringe idea. For a lot of families, this is the retirement plan. But there is a gap between owning rentals and living on rentals. Almost nobody maps out where that gap sits. By the end of this, you will know the exact line item that swallowed her 6 figures, why hiring a property manager does not close it, and the single distinction that separates the people who quit from the people who are still doing fine. Start with her own arithmetic, because it is better than most. Kebede says her 22 units average about $600 a month each in cash flow. That is roughly $13,200 a month. About $158,000 a year. She also says the typical investor in her world aims for around $200 a door, so her number is well above average. And she says the 6 figures is not really 6 figures. Her explanation is simple. As you scale, the money coming off the buildings goes straight back out. It buys the next property. It covers the last repair. The figure exists. It just never lands in a bank account you can spend from. That is the first crack. Cash flow is a number you calculate. Money in your pocket is a different number entirely, and only one of them pays for groceries. Now look closer, because she gives a worked example that explains it better than any spreadsheet. Picture a single-family house you rent out, cash flowing $400 a month. Kebede calls that above average, and by her own benchmark, it is double what most investors chase. So this is not a bad property. This is a good one. Then the roof goes. A new roof in her example costs $5,000. $400 a month for 12 months is $4,800. So the roof does not dent the year. It eats the entire year and then some. That is the whole trap in one number. A good property produces less in 12 months than one predictable repair costs. And roofs are not surprises. Neither are water heaters, air conditioning systems, or windows. Every one of them has a known lifespan. Experienced landlords in the comments under that video ran the correction, and it is worth hearing. Their rule is to hold back 15 to 20% of gross rent for repairs and big replacements, plus another 5 to 10% for the months a unit sits empty, before you call anything cash flow. That is up to 30% gone before the calculation even starts. Almost nobody does that math on the way in. Everybody does it on the way out. Now for the part that surprised me, because it is not the tenants. Kebede walks through one of her 2-unit buildings. Upstairs rents for $1,300 a month. Downstairs rents for $1,100. The mortgage is about $1,300 a month, so the upstairs tenant covers the whole mortgage on their own. That sounds like a win, and in a way it is. But she breaks the payment down further. Of that $1,300, about $900 is principal and interest. The bank is the single largest tenant in the building, and the bank never misses a payment or moves out. She has a phrase for where that left her, and it is the most useful 4 words in this whole topic. Equity rich, cash poor. The buildings were worth more every year. The bank account was not. She describes checking whether her balance had gone negative and wondering about gas and groceries while owning 22 units. When repairs came up and the cash was not there, she says they put them on credit cards. She adds, plainly, that she does not recommend that. Read that again. 22 units, a 6-figure paper income, and repairs going on plastic. There is a second thing that moved underneath all of this, and it did not come from any guru video. It came from the Federal Reserve. In September of last year, Federal Reserve researchers published a note on rising property insurance costs for apartment buildings. They measured the average insurance cost per unit going from $39 a month in 2019 to $68 a month in 2024, adjusted for inflation. That is an increase of more than 75% in 5 years. Sit with what that does to a plan built years earlier. Somebody who bought in 2019 and penciled in $39 a unit was not careless. They used the real number. The real number then nearly doubled while they were holding. Property taxes moved in a lot of places too. Rent in most markets did not move 75%. That is the quiet version of this story, not a disaster. Just every fixed cost drifting upward against an income line that drifts slower. At this point, there is an obvious objection, and it deserves a real answer. Just hire a property manager. It is a fair thought, and it does remove work. It does not remove the problem, and the people who tried it say so. One commenter under that video, who says they have been in the industry for 16 years, sold every rental they owned. Their two stated reasons were the amount they were spending on repairs and dealing with a run of bad property managers. The manager did not make the repairs cheaper. It added a fee on top of them, and a manager cannot help with the two costs that actually did the damage. The bank still wants its $900. The insurer still wants its increase. Which brings in the second person who went through this and wrote the whole thing down. Joel O'Leary is a personal finance writer at Motley Fool Money. In August of last year, he published a piece explaining why he sold 6 rental properties and moved everything into index funds. He owned mostly small multifamily buildings, duplexes, and 4-unit places. His reasons line up almost exactly with hers, from a completely different direction. Repairs and management that scaled with every extra unit, even though he was paying somebody to handle it. Down payments over $50,000 per building, which made the whole strategy slow and hungry for cash. Most of his net worth sitting in a handful of buildings, so one long vacancy hurt badly. And no way to sell a third of a duplex when he needed money. Then he gives the number that reframes everything. His best performing rental returned about 12% a year. He says that matched the S&P 500 over the same stretch. 12% is a genuinely good return. That is the point. He got a good return, and an index fund got the same one without a single phone call at 11 at night. There is a sentiment that shows up under every video on this subject, in slightly different words each time. My stocks do not call me in the middle of the night. So here is the distinction the whole thing actually turns on, and it is not the one you expect. The most upvoted criticism of Kebede's video was not that rentals are bad. It was that she was trying to live on the income from the very beginning. And that, according to those commenters, is not how the timeline works. Owning rentals and retiring on rentals are two different things. In the early years, a mortgaged rental is mostly a machine for converting a tenant's rent into your equity. Equity is real wealth. It is just not spendable wealth, and a person who has stopped working needs spendable. Kebede got there herself. She says she would rather own 30 properties paid off than 100 properties with mortgages on them. Same buildings, completely different life, because the bank is gone. That is the regret. Stated precisely. Not that she bought rentals, that she retired onto them before they were finished paying for themselves. And it is worth being fair about the other side of this, because plenty of people are doing fine. Dion McNeely, a Washington investor who retired early on his own rental portfolio, spent a year talking to former landlords who lost money and had to sell. He kept his. Business Insider reported this summer that a lot of investors who wanted the cash flow are shifting toward more passive structures instead, with one saying he still wants real estate exposure without personally buying and running a 20-unit building. At Kiplinger, an advisor wrote in April that the question he gets constantly from retirees is whether to sell the rental, because they have discovered they do not want to be a landlord. Notice that nobody in any of this is saying real estate does not work. They are saying the job is a job. So, one sentence. The people who regret retiring on rental income did not get less money than they expected. They got money that was already spoken for by a mortgage, a roof, and an insurer. Knowing where that gap sits is the difference between reading a cash flow number and understanding it. I want to hear from the landlords watching. What was the repair bill that wiped out a full year of cash flow on one of your properties? Put the number in the comments.